Folks, I'm here today to talk straight to you about something that's hitting our wallets hard. It's no secret that American households are now coughing up $1,000 more each month just to get the same things they did 3 years ago. That's right, you're not imagining things. Prices have soared, and it's pushing more and more of our fellow Americans to lean on credit cards just to get by. But let me tell you, it's gotten to a point where almost half of all Americans, and I mean folks from every generation, kids, Gen Z, millennials, you name it, are trapped in what's nothing short of a credit card debt crisis. Now, why is this happening? Recent reports, like one from the Urban Institute just this Tuesday, paint a grim picture. 52% of our people are in families that can't even afford basic necessities without pinching pennies or foregoing other essential needs. We're talking about families that can't fully participate in our economy or society because they're too busy trying to figure out how to survive. Since 2021, the cost of just living, groceries, clothes, you name it, has shot up by $925. Think about that for a minute. Take the story of Rebecca Miller from Ohio, a CDC analyst whose paycheck isn't stretching as far as it used to. Rebecca tells us that the cost of living in her area has skyrocketed so much that she had to move out of Cincinnati just to afford rent. The grocery store is just outrageous right now, she says. And it's not just food. Everything from clothing to insurance is going through the roof. Rebecca is feeling the squeeze so much that she had to pack up and move to a more affordable area. And she's not alone in this. Many are finding that the dream of simple, stable living is slipping away. Folks, this isn't just tough, it's unsustainable. When seniors have to unretire to make ends meet and children are sinking into debt, we've got a serious problem on our hands. We're looking at a whole generation here struggling under the weight of financial pressures that they shouldn't have to face. It's high time we addressed this crisis head-on, looked at the facts, and started asking some hard questions about where we go from here. Stay with me because we're going to dig deep into what's really going on and why it's crucial that we act now to turn things around for the average American family. This isn't about politics. It's about protecting our way of life and ensuring our children have a future where they aren't already burdened by debt before they even get started. Folks, let's zero in on a real zinger from the Urban Institute report. A staggering 65% of Americans are saying loud and clear that the rising cost of living is the #1 economic problem facing their families today. Now, that's a significant majority. With costs sky high and wages barely budging, it's no surprise many are turning to credit cards as a lifeline. But here's the rub. These aren't just pieces of plastic for convenient shopping, they're lifelines for many who are struggling. Credit cards? Sure, they're handy. They build your credit, they offer rewards, and they let you make ends meet when the cash isn't there. Most folks, bless their hearts, plan to pay off their balance every single month. But as we all know, life doesn't always go according to plan, does it? That's where the trap springs. Nearly half of all cardholders carry a balance, and today, they're shelling out for historically high interest rates on debts they barely understand. Let me tell you, this wasn't part of their plan. Lending Club analysts hit the nail on the head. They say this unintentional debt is like being stuck on a hamster wheel, causing not just financial instability but also chipping away at people's mental health. And get this, many consumers don't fully grasp that using their credit card is essentially taking out a loan. They aren't shopping around for the best interest rates. They're not keeping an eye on rate changes or the fine print. Truth be told, most folks don't even know the interest rate they're paying. Can you imagine? Almost 25% of people use these cards as a stand-in for cash, and a small chunk even thinks it's a safer bet than debit cards. Meanwhile, a good portion of Americans use credit cards to build credit, or for the perks like cashback. But here's where the plot thickens. Credit card usage has skyrocketed, with 47.3% of Americans now bogged down by revolving credit card debt. As of this last October, Americans collectively owe a record-breaking $1.17 trillion on their credit cards. That's trillion with a T, courtesy of the latest scoop from the Federal Reserve Bank of New York. The bottom line? This growing reliance on credit cards is setting folks up for some serious financial headaches if they can't clear those balances each month. And guess what? More than a quarter of our fellow Americans are using up to 40% of their paychecks just to chip away at credit card debt. That's a heavy yoke to bear, and it's not easy to shake off. In fact, About 40% are sweating bullets over the possibility that just one missed payment could throw a wrench in their financial plans for the next 6 months. I have a simple favor to ask. If you're finding this discussion interesting, please give it a thumbs up. Your likes and comments mean a lot to us and help others find this content. If you haven't already, consider watching the whole video to support our channel. Your engagement is crucial and enables us to keep providing detailed analyses of global events. Thank you for being a part of our community. The emotional toll is just as real. People are feeling anxious, overwhelmed, frustrated. They're ashamed, angry, scared, embarrassed, and some are downright hopeless about their pile of debt. Let's not mince words. This is a dire situation for many hardworking Americans. We're talking about a financial squeeze that's tightening its grip on the average Joe and Jane, making it tough to breathe, let alone thrive. We need to have a serious conversation about this, folks. It's high time we looked these challenges in the eye and started figuring out a way forward. This isn't just about numbers on a page. It's about real lives and real struggles. Folks, let me tell you about Robert, a hardworking apartment maintenance guy from Fiat, Alabama. Robert found himself in a real bind when a $2,000 debt on his credit card doubled to $4,000 in just 1 year. And what's his take on this? He says if the Federal Reserve would just lower the interest rates, he could handle his debt a lot better. It's so stressful. Lots of people are in this situation, Robert tells us, but here's the kicker. Just this Wednesday, the Fed decides they're leaving U.S. interest rates at a whopping 4.28%, a 10-year high. Imagine that. Robert's situation is a perfect storm. He's borrowing more than ever because everything's more expensive and wages in rural Alabama just aren't keeping up. Every day he's wrestling with how he's going to pay back what he owes. After a tough negotiation with his lender, he's locked into a repayment plan stretching over the next 4 years. I'm tied to one loan for 48 months, but who can even plan for that long with the way things are now, he laments. And Robert isn't alone in this struggle. Managing credit card debt is like trying to juggle knives in the dark for many Americans. We've got multiple balances, fluctuating interest rates, and due dates all over the calendar. It's a mess. Despite our best efforts to pay down these debts, it's an uphill battle. Most loans might auto-pay, but a whopping 68.4% of us are still manually paying our credit cards every month to keep some kind of control over who gets paid and when. But here's where it gets downright disturbing. Some folks are so desperate to find a way out of this financial quagmire that they're resorting to stealing their own children's identities just to access more credit. Can you believe that? According to a landmark study by Carnegie and KAB, kids are 51 times more likely to become victims of credit card fraud than adults. Roughly 1 in 50 children have a credit card account fraudulently opened in their name every year, and a shocking 73% of these victims are targeted by someone they know, often from their own family. Harry Ravichandran, CEO of the digital security firm Aura, sheds some light on this troubling trend. He says it often involves families in dire straits, dealing with major economic pressures or addiction issues. Kids get a social security number at birth, which typically lays dormant until they hit 17 or 18. That means there's a long stretch where that number is just sitting there, clean and unused, a tempting target for someone desperate enough. Many of these young victims don't even find out their credit has been wrecked until they're adults trying to get their lives started. Suddenly, they can't get student loans, can't buy a car, or struggle to find affordable housing because of a ruined credit history they had no hand in spoiling. Ladies and gentlemen, this is no small matter. This is about the financial security and future of our families, our children. We're talking about a system that's leaving too many good folks like Robert and innocent children in its wake. It's time for a wake-up call. It's time we demand better oversight, stricter controls, and real support for Americans grappling with debt. We need solutions that don't just put a Band-Aid on a bullet wound. It's high time we stop this madness and ensure that the American dream is accessible to all, not just a debt-laden nightmare. The future is looking tough for our young folks and our seniors alike. It's a bitter reality that many young Americans, particularly those in Generation Z, are sinking into deep credit card debt even before they hit 25. Why? Because their earning power is lower and their savings are thinner than ever, which forces them to rely on credit just to cover basic needs like rent and groceries. The numbers speak volumes. The average credit card balance for 22 to 24-year-olds at the end of last year was $2,834. That marks a staggering 26% increase from what millennials faced at the same age a decade ago. And it's not just the young feeling the squeeze. Our seniors, those who've spent a lifetime working, are being forced out of retirement because their debt is mounting uncontrollably. According to the 2024 Employee Benefit Research Institute Spending in Retirement Survey, a whopping 68% of retirees are wrestling with outstanding credit card debt. About 31% of them are spending way more than they can afford, nearly double the percentage from just 4 years ago. Bridget Bond, a research strategist at EBRI, finds this trend alarming, especially for retirees on fixed incomes. She points out that as inflation drives up the cost of basic necessities, seniors are finding themselves backed into a corner, forced to charge more and more to their credit cards. Let's talk about the reality of these adjustments. Social Security does provide an annual cost of living adjustment to help retirees cope with inflation. But guess what? It's not enough. Not by a long shot. Since this inflation crisis kicked off, Social Security recipients have lost about 20% of their purchasing power. Imagine that. You work all your life, pay into the system, and when it's time to rely on that safety net, it frays beneath you. This leaves the average 75-year-old with a median credit card debt of $11,700, and those aged 65 to 74 aren't faring much better, with $3,500 in credit card debt. Take Robin, for instance, a 70-year-old retired arts teacher from California. She lives on a meager $14,400 a year from Social Security. That's $14,000 for a whole year, she tells us. I became disabled and retired about 20 years ago. My life was manageable then, but now, with prices for basic goods like bread and gasoline skyrocketing, I run out of money every month. So what does she do? She turns to her credit card to make ends meet, a cycle that's been going on for over 6 months. "I'm so worried," she says. "How will I ever pay this back when everything costs more and more?" This vicious cycle of debt is draining the lifeblood of everyday Americans. Credit card delinquency rates are soaring to heights we haven't seen in over a decade. Borrowers are simply too financially exhausted to keep up. This is a dire sign for our economy, which relies heavily on consumer spending to fuel growth. Yet, with layoffs on the rise, stagnant wages, and prices continuing to climb, we're seeing a painful slowdown that's hurting businesses both large and small. Gregory DeCoe, a chief economist, laid it out clearly. The combination of subdued job growth, sluggish income progression, and diminished savings is causing a spike in delinquencies and a nationwide retrenchment in consumer spending. Folks, we are staring down the barrel of a crisis of catastrophic proportions. It's a crisis that's not just about numbers on a page. It's about real people, real struggles, and the very fabric of our society being pulled at the seams. Thank you for tuning in. We must face these challenges head-on, not just for our own sake, but for the sake of future generations. Let's not wait until it's too late to act. Stay vigilant, stay informed, and let's work together to turn this ship around.